All right, we'll go ahead and get started here. Good morning to everybody. I hope you're having a nice fall day today. November. We haven't, knock on wood, seen snow much. We had a little dusting come up a few weeks ago, but that just gets rid of the mosquitoes. So I'm real excited about this. We've had a lot of questions come up from clients and just people that we're communicating with just about the market. So we did a market update back in the middle of September. So there's going to be some redundancies with this presentation, as not a ton has changed, but some has changed. So let's get started. So this is the market update for November 2023. So agenda for today, always want to start with an agenda. We're going to touch on where we are now. We're going to go through some of the major, I would say, roadblocks or obstacles that are out there and really identify what's going on. And then we're going to look ahead. Okay, what do we have to anticipate? What are we looking ahead to? And of course, we're going to talk about some opportunities. With volatility comes opportunity. And we've had a ton of change and a ton of volatility occurring. So there's opportunities that are out there. I'm excited. I'm going to share a few stories from clients actually over the past few weeks that we've been going through where we've identified some of that opportunity, which is very exciting. So what's going on? Let's address this here. So number one, interest rates have continued to stay elevated or at elevated levels. So we just went through, congratulations to everyone on this call. We just lived through the fastest rate increase in US history, meaning that the Federal Reserve increased interest rates like a hockey stick. They went from literally the Fed fund rate of 0 up to over 5% in a matter of, really 12-month cycle. So it's the fastest rate increase in US history. The reason they do that is to try and crush or reduce inflation, right? So we do anticipate that interest rates are going to stay fairly elevated in the foreseeable future, as we do not want inflation to rear its ugly head. And we're not quite there against that battle. If you listen to the Federal Reserve, they're talking about how it has remained persistent. We're going to talk about that. There is world unrest, and I should have capitalized that. It just continues to be a wild time in terms of just the world in general, right? You look at Russia and Ukraine, the amount of aid that we've sent there from the US. You look at the Israel-Hamas conflict and the fear of bringing Iran into that. And, you hear about those rumblings of a third world war, all those things that we prayed will never come to fruition or happen. They're there at the doorstep. So there's a lot of unrest there. You see student loan payments started back up. That's a big deal that you don't hear a lot about, which is odd, right? You're not hearing that these student loan payments, which have been on forbearance for 3 years, are now kicking in, and what kind of impact that will have on the economy going forward. And then governmental spending. We haven't talked about this one as much, right? We talked about governmental shutdown previously. We're going to talk about that again a little bit, but the governmental spending is something that I want to bring to the forefront here as well, that we're paying attention to. And then obviously, again, right, there's opportunities that are out there that I want to make sure that you're aware of, so you can take something away from this and say, how do I capitalize on the current times that we're in? So let's get started here. So there's 10 sectors in the S&P 500, right? And I want you to think this year of the 10 sectors. So those 10 sectors would be technology, healthcare, financials, utilities, energy. Okay. Of those 10 sectors year to date, I want you to ask yourself the question, okay, how many of those sectors are positive? And think that in your mind. Of the 10 sectors in the S&P year to date, how many have been positive? And the answer to that is one, right? So technology is the only sector in the S&P year to date that has a positive return. And when you look at that, right, the S&P year to date is up 13.68%. So it just tells you it's a tale of two stories, right? A person from the outside, if you're not in finance every single day, would look at this and say, well, the market's up 13.68% year to date, right? That's good. That's a great return. But truly, when you look at the overall pie chart of the economy, all 10 slivers that make up the S&P, right? Technology is the only sector that's positive. So what's interesting is the reason I say a tale of two stories is technology was the most oversold sector last year. It was down over 40% from where it was during the pandemic or pre-pandemic levels. So you're seeing that whipsaw that occurs. Now, the reason that the market's up 13% and only one sector is positive is technology makes up 28% of the S&P 500. The issue with technology is what goes up really fast comes down really fast, and you see that whipsaw that comes from it. Also doesn't pay typically a dividend, and it's something that's going to be extremely volatile compared to, the other sectors that are tied to the markets. When we look at the S&P, though, even with a 13% recovery year to date, you can see from when the volatility started, so at the end of 2021, beginning of 2022, even with the volatility, right, and the recovery we've seen year to date, the market's still down almost 9% from where it was at a high. So, there's two different terms, and I've been doing this with clients and going through this to educate because I honestly believe that society does a horrific job of educating individuals on anything financially related. And I don't know why, but it is just, they do a horrific job of explaining different pieces. So the number one piece that I want to touch on, and we went through this last time, and I do this with clients, and I'm amazed at where our mind goes right away. Okay. There's a term called average return versus real return. So when you start bringing money into the fold, that is when your return becomes weighted, or they call that a real return. Okay. So think about it. If you start with $1 million and you invest in the S&P 500, and let's say the S&P is down 50%, okay, your million just turned into $500,000, right? That's a 50% reduction. The next year, let's say that the S&P is up 50%. So it's down 50% one year, up 50% the next year. Your average return was zero, right? Negative 50, positive 50 over a 2-year period, zero. Okay. So when we look at that, that's what you hear on the financial news. That's what the analysts celebrate. Oh, the market was down 18% last year. It's up 13% this year, right? They're looking at the average return across the board between the two. But when you actually bring money into the fold, the market's down 50, your million turned into 500,000. If the market's up 50 the next year, you're only gaining 50% off of that $500,000 balance. Even though the market's average return was zero, you're still down 250 grand. And that's what's frustrating for investors, is because they're looking at the paper saying, well, the average return is substantially higher. Why am I down so much? It's because you're growing on a smaller number, right? If you're down 50%, you need to get 100% return on your investment just to get back to where you started. So the real key, especially for those that are pre-retirees or in retirement, risk mitigation is so important. You can't afford to be down 20, 30, 40% and be taking a distribution and expecting to recover. Risk mitigation is so important during those volatile times. And then having a reliable income that you can pull from where you don't have to deplete shares, that's what allows you to capitalize on the upside. We'll talk about some of that here in just a second. But when we look at average versus real return, this is something that's not talked about enough. So let's put that to practice, right? So I used Amazon stock last time as an example. I'm going to use it again. So look at Amazon year to date. Amazon is up 63% year to date. Okay, that's fantastic. Great company. Amazon was down almost 60% last year. So when you see this, most people are seeing this. They're saying, well, Amazon's up 63%. This is one of the top 5 companies in the S&P, right? This is why the S&P is showing positive, even though one sector is only positive of the 10. But if we look at Amazon from the beginning of 2022, right, when the volatility started, even though they're up 63%, remember, they're up 63% of a smaller number. They're still down almost 24% from where they were at their high. So that's where, the proof is not always in the percentages. You have to take a step back and say, okay, where were we? Where are we now? That recovery is true from Amazon, but it just happens to be that's when they were at their bottom. So of course this year is going to look great, but they still have a long ways to go to get back to that $183 per share price they were at previously. They're only trading at 140. No, don't get me wrong. Amazon's a great company. We like them. They're going to be there for a long time. I'm just giving this as an example. Okay. So inflation, we've talked about this before. Inflation is typically a sign that the economy is overheating, right? That's what inflation is. It's when supply, right, cannot keep up with demand. So the cost of products go up. So think about after the pandemic, people had pent up demand. They wanted to go places. They wanted to go on vacations. They wanted to go to restaurants. We were told we couldn't for health purposes. So we're at a point where people had this pent up desire. As soon as I can go, I'm going to go. And you used to hear like that YOLO, you only live once acronym. And people were willing to spend and they were going to travel and do things. And, we also saw an inflow of support from the government, right? Both political parties. This is not meant to get political. We passed stimulus under the Trump administration and also under the Biden administration. And that infused, over $4 trillion of economic aid directly into the hands of consumers, and they started spending. They found this extra cash flow, right? Hey, if you didn't have to spend or pay off your student loans for 3 years, that's on average an extra $500 a month that you save that people started spending. And all of a sudden you get a stimulus check and we were spending. And I'm not traveling as much because of the pandemic. So I have extra cash flow and I'm spending. And you just saw this continue to trickle down and the supply chain was broken. Right, we couldn't get stuff off the ships because we just had essential employees. We couldn't transport it. We were having issues with other countries with importing or exporting products. So all these things were occurring, and what it did is it created this huge, huge bubble of inflation, right? A huge desire to buy things. You'd go to a car lot, there's one car, 20 people want to buy that car. All of a sudden, they're selling it for 10%, 15, 20% over MSRP, and they don't even have to negotiate. It completely changed all of these different sectors. Now, with that being said, what the Federal Reserve does, right, their playbook per se, and it's always been their playbook, is we're going to make things more expensive by charging more interest. We're going to strategically cool down the economy. So what they're doing is they're raising interest rates. So think about car loans, right? Car loans, 8 to 9% interest right now. People start to second guess if they're going to be buying that additional car because it's a lot more expensive than it used to be, right? If interest rates go up on a mortgage, and now you're paying 7.5%, 8% on a 30-year fixed mortgage. And I know for some of the older clients on this call, you might have had a 12 to a 17% mortgage, so 8% doesn't sound so high. But those pre-retirees that have never seen an interest rate over 5%, right? 7 to 8% is pretty high. So what ends up happening is if you're paying more towards interest, you can afford less home. So if you can afford less home, what do home prices start to do? They start to normalize or levelize or even possibly decrease in some of those highly priced areas. It starts to bring down the desire that people have because they have to choose between their lifestyle and living expenses versus their wants. And if they're spending less on those wants, obviously that's less consumer spending. It's strategically cooling down the economy. The supply chain can fill back up. Right now you have an abundance of inventory. Nobody wants to buy it. What's the price do? Starts to decrease. That's the playbook that the Federal Reserve uses. And inflation has been coming down. Right? Inflation's been decreasing. We were at our 40-year high last July at 12.7 on the CPI index. We're down in the 4 range, and the Federal Reserve wants to get it to 2. They want inflation to be right around that 2% level. So that's where I'm saying when we talk about interest rates, we see interest rates continuing to be high for the relative future. Now, when I say high, that doesn't mean dramatic increases going forward. Okay. We've seen it just like I talked about. It's been a straight line up over the last 12 months. We do not see that repeating itself. Now, no one on this call should envy Fed Chairman Powell. Talk about being between a rock and a hard place. And I give him credit because he has held true to his word. And he's releasing information ahead of time saying this is what our game plan is, and he's fulfilled all of that. He said, hey, we're going to continue to keep the pedal to the metal. We're going to increase. Now they're going through what they call a strategic pause period due to some of the risk factors that they have no control over, right? Oil prices increasing, world unrest, those types of events. So when we look at interest rates going up, what's happening is they're making credit more expensive, just like we talked about, but it also creates an opportunity. So if you guys are taking notes, this is what creates an opportunity. I have been meeting with clients the last few months that have had, for lack of a better word, some lazy money or emergency fund money on the sidelines. And, for the last decade, it didn't matter if you had money in a money market, a CD, a savings account, interest rates stunk across the board. Didn't matter where they were, they paid little to nothing. I'm telling you right now, if you have that lazy money, give us a call so we can come up with a plan to get you some return on it. Okay. I mean, we've been laying out for clients plans utilizing FDIC insured products, so zero risk products, looking at CDs, money markets, different types of accounts, that are paying anywhere from 4 to 6% interest, and allows them to have that protection, still have access to the funds, but ultimately not have to go through the ups and the downs, and doesn't have to just sit there and do nothing. So I met with a client actually 2 days ago, and we went through a plan, and we were able to get their interest to a point where it covered their mortgage payment for them, for gosh sakes, right? Because their mortgage they're paying, they locked that rate in 2 years ago at 2.5%. And, it's a smaller amount. They had great cash reserves. We built out a plan. Their interest pays the mortgage payment for them. And we just freed up that cash flow on a monthly basis. So that's where the planning comes in. So if you haven't gone through that, you need to sit down with the team and start diving through some of those planning on that cash end on how we get that working a little bit harder for you. In terms of student loans, excuse me, starting up again, this is a big deal, right? So you can see this was at the end of 2021. We were at 1.75 trillion in federal student debt. It's continuing to push higher, but student loans starting up again is one of those hidden costs that could drive inflation further, or it could actually cool inflation faster. So most people are saying, well, it's going to drive inflation up more because it's another expense. No, it's not going to drive inflation up more. What it's going to do is it's going to take money that people were spending on other items, and now they're going to be spending it on student loans. So it should actually cool inflation faster. The Federal Reserve has been extremely hesitant to restart student loans because of the fear of what it will do to the economy, right? 2020 is when the pandemic started. It has been in forbearance until this month. So we are almost 4 years in to forbearance on student loans with zero interest. And now those payments are restarting. And I've sat with a lot of people. And as we've gone through, the frustrating part is there was a lack of guidance with the government. And they had promised some student loans to be forgiven. That didn't necessarily come through for everyone. Some of that's still in court. So there's people that are up in the air. And then there's other people that failed to plan. And they had an opportunity to pay 0% interest on these for the last 3.5 years. And they didn't even have to pay the same amount they were paying before. They could have paid any excess they had towards it just to help deplete that principal, because you're only paying interest on the remaining balance. So what's happened is they got used to spending that money. I have a client, he called me 3 years ago when this started. He said, Tyler, what do you think we should do with this student loans, right? They have about $60,000 in student loans. What do you think we should do? Because we don't have to make this payment. And I said, I think you should still make the payment. They're talking at the time, they were talking about forgiving a pretty substantial portion, and they would have qualified. And I said, what I would do is I would back out the math on what they would be forgiving. And we could put that to the side because there's zero interest. And let's pay the amount per month that you were paying anyway towards the remaining debt that's there. And we would have had it paid off by now. They didn't. They went out and bought a UTV. They bought a Ranger, a Polaris Ranger. and they're making the payments. And now what's happened is the student loans are kicked back in. They have to make their student loan payments, which are about $500, and they still have to make the Ranger payment. And they're calling me because cash flow is extremely tight because they didn't follow those steps and plan ahead. So student loans kicking in will take some cash flow out of the economy that people were spending previously because they have to make those payments back, which should actually decrease inflation, but it could put certain consumers in a bit of a bind in the short term. So just be aware of that. It is something that we're paying attention to. That's not good nor bad, right? We never want people to be in a financial bind. The interest rate that are being charged on some of these student loans are completely ridiculous, and it's a crime from the government standpoint. It makes me really angry because they charge so much darn interest, but at the same time they didn't fix that problem, right? The government has not addressed or fixed that problem, and we're continuing to monitor this going forward. The next big one that I want to touch on is governmental spending. So I'm going to ask a question here. Okay, this is the statistics that we just went through during our investment committee meeting early last week. So of all the money the U.S. has printed since the inception of the United States, so since our great country started, all the money that we've printed all those years, okay, how much do you think, what percentage of that money do you think has been printed since the pandemic? So I'm going to repeat that question. Of all the money we've ever printed in the history of the United States, how much of that money, what percent of that money printed has been printed since the pandemic? Think of that number in your head. 40%. We have printed 40% of the entire amount the United States has printed in total money in the past 3.5 years. That is a lot. And what that says is our government is spending at an exorbitant level, which is something we need to plan for, right? And we are planning for it. The reason I bring that up is if we continue to spend at that level, tax revenue and income for the government also has to increase. So that's something we need to be prepared for as financial planners to help you to say, okay, how do we prepare better to offset taxes in the future if they do increase? How do we prepare better if governmental spending doesn't decrease and inflation stays persistent, right? We need to be positioning for that. This statistic, when I heard it, just blew my mind. So I just thought I would share. There's a lot of world unrest. Okay. So you've seen this slide a few times if you've sat through these. And, in addition to Russia and Ukraine, what the United States had done previously is we would sanctioned Russia to penalize them. And then we've been financially backing Ukraine. And that's part of the spending that we've seen here in the short term. And now Israel and Hamas are becoming more and more in the news. Israel is obviously an ally of the United States. Hamas had a terrorist attack against Israel, and Israel has been going after Hamas in a very, very aggressive manner. And what's happening is other partners of the Middle East, such as Iran, are looking to possibly get involved, and then it becomes a different conflict. Even if we don't get directly involved with that conflict, that can start to trigger oil prices to increase. And if oil prices go up, obviously that can lead to additional inflation. So it is something that is becoming more and more apparent and more of a worry for economists across the United States, because we don't want to see gas prices jump because that can drive inflation higher. And that's something that interest rates don't have an impact on, right? Just because your mortgage rate goes up has no bearing on gas prices. So it's one of those pieces that we are continuing to monitor as well. Right now, oil has stayed fairly level. We have been utilizing with the United States a lot of our strategic oil reserves over the past 2 years to keep oil artificially low. And we need to make sure that we're replenishing those reserves so we can continue to do so if needed in the future. But there's always going to be, don't let that scare you. There's always going to be some form of world unrest because there's so much we can't control. There really is. There's so much out there that we cannot control just in general. So key takeaways. Okay. So if you're taking notes, these are the key takeaways here. We're going on 26 minutes, so I wanted to keep this to a 30-minute presentation. So higher interest rates, as we talked about before, are creating opportunities we haven't seen in the last 15 years. So there's interest rates out there, whether you have CDs, we need to look at those, whether you have, savings accounts that need to move to a money market, whether you have one, and this is the crazy part. I've got a client who had a money market at Chase getting 0.02%. I got a client who's got a money market at Ally getting 4.4%. Same vehicles, but literally a 4.2% difference on interest rates. So that's where you have to pay attention to some of these opportunities that are created. Even inside of the investment vehicles at this point, there's different investment vehicles that have guarantees that we're seeing some of the highest rates we've seen in the last decade because of the interest rate, excuse me, increases. As we talked about before, there's some low risk investments that are yielding attractive rates at this point. And that's creating an opportunity. And we can look at, okay, utilizing some of those now. They will not be there forever. Rates will not be, at elevated levels forever. But, I grew up in the farming community, right? Make hay when the sun shines. So we have an opportunity here to utilize some of those rates in the short term. It also helps offset a little bit of the volatility that's occurring for some people that aren't as comfortable with long-term investing. So we have the ability to look at reducing risk exposure for the future. That's where I talked about some of those pieces that have guarantees attached to them, whether it's an income benefit or some kind of death benefit that have guaranteed rates that are backed by insurance companies. Those are starting to become more and more attractive with the rates that they have available. And then also, right, remember, the best time to buy is during volatility and when something's at a discount. So if you go to the grocery store and you're looking to buy something and all of a sudden it's 50% off, pretty good time to pull the trigger and buy it, right? Because ultimately what you're doing is you're allowing yourself to buy twice as much for the same amount of money. So it's utilizing the assets that you have to generate more. So one strategy is a story we built with a client. A client inherited about $300,000. They're saying, okay, what do I do with this? And I said, well, what's your goal with the money? And they're unknown, but they're very nervous. And I said, if you're nervous, let's put the money in something. And we put it into a CD. Okay. That CD yielded them 5%. It was a certain CD that paid interest monthly. And I said, the best time to buy into the market was when everybody else is selling because you're buying at a discount. So we took that 5% interest off that CD, which is $15,000 a year. And we utilize that on a monthly basis by dollar cost averaging that directly into the market. And we've done that, right, since the volatility had started, but we started a few months later, right? The market was really down. It was when the Dow was close to 31,000. It's back up to about 34,000 now. So the advantage is they still have the 300,000 in principal, but they've made about a 15% return by dollar cost averaging on that 15,000. So they not only made the interest and still have that, they have the additional growth above that, and they're going to hold that for a long time, right? They're going to hold that forever. That's their growth money. And, they're playing with house money per se, and it's just getting that money in motion, right? And there's different vehicles they can use, whether it's funding a Roth or after-tax accounts to do that. And then this is so important for those of you that are looking at retiring or are retired. You need to insulate your cash flow. So, I think of a company like AbbVie or Abbott or McDonald's or, any of these nice dividend paying companies that are out there. Okay. Dividends are based on the number of shares you own, not the share price. So if you read a financial report, right, and you're holding a company like McDonald's, for example, pay $1.67 per share. So their dividend, they pay you $1.67 per share that you own of the company. Didn't say share price. It's per share. So it doesn't matter if the share price is down or up, you're still getting $1.67 per share for their payout rate. And that's where your income comes from. So you can sustain volatility in the portfolio if you're drawing income because you're not reducing your principal. You're not touching your shares. You're simply just waiting for those to go back up. So you need to insulate your cash flow through that yield. And that allows you to be able to weather these ups and downs and sleep at night, knowing that your check is just going to continue to come in every single month. So some opportunities that we're working through with clients right now. Tax loss harvesting is key, right? We've had a great 5-year run in the markets up to the last few years, which have led to some substantial gains in many after-tax accounts. This is just for after-tax accounts. Okay. With that being said, the last year has created some volatility. There may be certain holdings that are underwater or down from when you purchase them. We can sell something at a loss, sell something at a gain at a zero tax liability. And then after 30 days, we can buy it back and it sets the cost basis at a higher amount for you, right? So there's some opportunity that's there that wasn't there previously. Roth conversions, if you don't need the money, right? If you have IRA money that you're not utilizing, you don't see yourself utilizing, or you are at a point where you really want to make sure you're leaving money behind for your kids, this is something to talk about. Okay. Roth conversions, if we think taxes are going to go up, what you're doing is you're paying taxes on some of the money now. I would rather see you do a conversion when the market's down than when the market's high. Because in a Roth, all of your gains are 100% tax free. So we would rather convert it a low so it grows from a lower number to a higher number and you have more tax free growth. Reallocating for the future, just went through this with a client yesterday. They have a portfolio they put together, and this was an opportunity to take some of their holdings that were a little bit more conservative, and we shifted a portion of them to be a little more aggressive because there was a buying opportunity in the sector they were looking at. Really, a fund or a holding that they liked was at a 30, or excuse me, a 52-week low, and we were able to acquire it, and they feel really excited about that opportunity going forward. And it's a great opportunity for contributions, as we talked about before. Just because the market's down or volatile, don't stop contributing. That's actually when you should put the pedal to the metal and contribute more, right? So it's one of those things. When it's down, you're buying more shares. You see bigger gains when the market does go up in the future, and it will again, right? We will see those times where we see all 10 sectors appreciating, similar to what we've had in the past. So looking ahead, right, we do see inflation continuing to ease. That's barring no wars, terrorist attacks, things like that. Interest rate increases are going to continue to slow. So they could increase rates again, another 0.25%. That would not surprise me whatsoever in 2023, but I do see them more flatlining or normalizing towards the mid to end of next year. And just be aware, there's still a lot of uncertainty out there, but there always will be. There always will be uncertainty. So just make sure you're taking advantage of what's being offered to you during these times so you can make sure you're insulating your income, getting higher yields, being able to purchase things at a discount, and really help your financial sense and financial picture for the future. So with that being said, as we talked about before, these are the bullet points that we went through. I'm not going to go through these in detail. This is exactly what we just talked about on the previous slide. But I'm going to open it up here. I've got Jenna Bradford, president of the Tranel Finance Group, on here to help me with any questions. I want to make sure we leave a few minutes here for any questions that people might have. I'd be happy to answer. So on the bottom of the screen, there's a Q&A button. You can simply click that Q&A and type in a question, and I'd be happy to go over it with you.
There are currently no questions, Tyler. However, you did a phenomenal job of thoroughly explaining everything, so we do appreciate that.
Absolutely. So with that being said, if no questions come in, feel free to reach out to us or shoot us an email with any questions that you have. We're happy to go through that, myself and the team, with any questions you do have. And we appreciate you, we care about you, and I really appreciate you taking the time to listen to the webinar. Hope you all have a great day.